Okay, number 8.
The gain or loss resulting from a downstream transaction involving assets that constitute a business as defined in IFRS 3 between an entity including its consolidated subsidiaries and its associate or joint venture is not recognized in the investor's financial statements. False, sir, because it should be recognized in the investor's financial statements.
Okay, that's correct. The word not is what makes it wrong. Can we proceed to 15 first?
Upstream transactions are, for example, sales of assets from an associate or a joint venture to the investor. True, sir.
Okay, true. And the opposite class, the opposite direction would be your downstream, as was mentioned in
Downstream.
number 8. Okay, so upstream and downstream class is just the direction of the transaction. Okay, it's possible, man, that you're the investor, you're the investing entity, and you made an investment in another entity, which we will call as your investee or your associate. If you have a transaction class, if you have a transaction with your associate or your investee, and the direction of the transaction is going towards the associate, then that would be downstream. Okay, you put yourself on top, man. You visualize it, class, as you, the investing corporation, you, the investor, as being on top. You put down, you visualize the investee, the associate, below the investor. Okay, you assume that the investor is the one that is rich. Okay, so you visualize that on top is your investor and below is your investee. If the direction of the transaction is going down, then that's what we are going to refer as a downstream transaction. If the direction of the transaction is from the associate to the investor, then we will call that as upstream. In problem solving class, the biggest issue here is the accounting for upstream and downstream transactions. In problem solving, if only the investor and investee did not interact with each other, if only they did not have any transaction between them, then the problems would be very easy to solve, class. What would be the source of difficulty in problems for investment in associates? It is when there are transactions between the investor and investee. Okay, supposedly the investor and investee are related, man. But if there are transactions between them, then that means one of them is trying to profit from the other. But the other entity is your related party, man. So if you make a profit of 100,000, but you own 20% of the entity, then that means you are trying to profit from the entity that you already own 20% of. So it's just like you are profiting from your own self, and that makes the problem solving difficult. But for us, class, for these topics, since we're just concerned with the theories, we just have to understand when is there a downstream transaction, when is there an upstream transaction, and whether or not the profit or loss, the gain or loss from that transactions will be recognized by the investee and the investor. And the answer is yes. The gains and losses from those transactions will still be recognized by the investor and investee. It's just that there will be slight adjustments later on when you will now be adjusting your investment accounts. But at this point, what's important for us to know is that the transaction will still be recognized by the investor and investee. Plus, important, do not forget the definition for downstream and upstream. To remember that, just visualize the investor as being on top and the investee as being at the bottom. Okay, number 9.
When the end of the reporting period of an entity is different from that of the associate or joint venture, the associate or joint venture prepares for the use of the entity financial statements as of the same date as the financial statements of the entity unless it is impracticable to do so. The answer is true. It's according to paragraph 33 of the standard.
Okay, that's correct. Okay, and I hope you can visualize na, class, the possible issues in accounting for associates ba? What if the associate ends on a different month than you end on December? And in preparing your records, you need the financial information of the associate man. Okay, you are using the equity method. You have to monitor the profit of the associate. So the rule is the associate will have to prepare a financial statement that will match the entity's reporting period. Another possible issue here, class, is that what if the investor and investee are using different accounting methods? What accounting method will have to be used? Okay, that will be addressed in a later question. Proceed to number 10.
When the financial statements of an associate or a joint venture used in applying the equity method are prepared as of the date different from that used by the entity, adjustments shall be made for the effect of significant transactions or events that occur between the date and that date and the date of the entity's financial statements. The answer is true. That's according to paragraph 34 of the standard.
Okay, so that's essentially the point in in number 9. Okay, so number 10 is also true.